Hello, everyone, and welcome to the SmithWeekly Uranium Summit, a special event in which we have two highly sought-after guests that are real proven veterans of the uranium business. Before we get into the discussions today, I wanted to cover a few administrative things for folks. First off, this event is for the enjoyment of our readers, followers, and the people who are going to watch this video. SmithWeekly is not trying to sell a newsletter or a report here, guys. This is a straight-up conversation with some industry experts that have been around for a long time. And so it's a purely educational presentation and event. And everything that we're discussing here is simply the opinion of the participants, nothing more. If you guys like what we've done here, SmithWeekly, of course, always appreciates folks who may donate to our research to help further our work. As most folks know, most of our stuff that we do is free and is donation based. So we hope you like it. And then lastly, we hope you're in a comfortable position at your chair and you can sit back and enjoy the event. So with that, I just want to check with everybody, make sure our participants are on the line. John Borshoff, are you there?
Yes, I am, Andrew.
And Dustin. Dustin joined us from London. Dustin, are you there?
Yes, I am, Andrew.
Okay, well, good to have both of you, and thanks for taking the time. I know you guys are both very busy with your work in the business, so I'll try not to take too much of the time here. Anyway, you guys know each other quite well. And with that, what I'd like to do just here, I'd like to have, if Dustin would, I'd like to have him introduce John, and then we'll go from John and have John introduce Dustin. So Dustin, take it away for a moment.
Okay, thank you very much, Andrew. Yeah, John is a true veteran of the uranium industry. You know, having started out in university in Western Australia, focused on geology, after he had spent some time in Vietnam with the Australian Army, which was an immediate link between us two. But in 1975, he joined Uranium Australia, and eventually became one of their senior geologists and headed up their activities in Australia and the Asian region. In 1992, when they decided to exit the uranium business, he made, I think, a very wise decision and acquired their database, which I know that invested tens of millions in developing, and had his own consulting group for really kind of a brief period. But then in 1994, founded Paladin Resources. Excuse me, I think it was 1993. Anyway, a while ago. And again, that was a period of kind of a struggle, but then made the decision to purchase the Langer Heinrich project in 2002 for a very modest amount, and that proved to be, I think, a brilliant stroke, which it eventually formed the initial production project for Paladin. I met John in 2004, where I joined them to provide marketing support. And again, we worked together for well over a decade as the Langer Heinrich mine was developed, and then Kalakira. And Paladin became a very large player in the uranium business, producing 8 million pounds per year. We both left in 2015. John went to Deep Yellow in October of 16, where he's been. So I think that gives, he's a 45-year veteran of the uranium business, kind of coming up on the technical side, but then going into executive management. So we had a bit of a different career path, but both decades in the business.
Very good. I appreciate that introduction. And John is a great guy to have around for this cycle. And John doesn't get out a lot. He doesn't go out and do a lot of things. He's hard to find, but he's out there focused on the ground doing work all the time. But he's not out there. You don't see him at all these conferences. You don't see him around that often because he's got his head down and he's doing the work, and which is really interesting and of course very appreciative in the sector there. So With that, I appreciate that introduction, Dustin. Now, John, would you handle Dustin for us?
I certainly will, and I haven't got the amount of detail that Dustin has of me, but I certainly one of the big remarkable things about Dustin's uranium experience is that he was, I mean, the US was one of the greatest producers of uranium in the sort of 50s, 60s, into the 70s. And it went through technological change from open pit to ISL, as it was called then. And in that whole period, there were remarkable people that were really foundation for the industry, and famously, he became involved in a very innovative sales group with what was his name, Dustin? Benton.
Yes, we're in Benton at New Exco.
Yeah, and this was really sort of forward stuff. People been sort of taking the norms out of selling and acquiring uranium, and shook a lot of traditional thinking on a business that had only had a 10-year or so commercial experience in terms of buying and selling this product that only became used for fuel for electricity generation, or really in post mid-60s. Before that, it had, of course, other uses built around secrecy and military, and some of those players that were in that period took those secrecies into the commercial side, and I believe it's one of the reasons why there's so much sort of commercial in confidence deals done. They're not as transparent as in other commodities, and but that's another story. But the Dustin, of course, was in the Navy, and got his sort of nuclear sort of interest developed from there, and I regard Dustin as one of the, yes, a true veteran, but a wide experience in understanding the sort of market side, but also, as he was close to a lot of those companies that were producing at that time, understands and understood the sort of issues that miners have, and the way in which product can go into the drum, and how difficult that can be, and then the next process in terms of getting it into the to the utilities. So I knew of Dustin before we actually met, and from people that were common to us both, and it was one of the reasons why I got in touch with him, and we'll talk a bit later why Dustin was such an important part of the Paladin side, because of what hadn't happened in a large scale in the uranium industry, where all the players that were in the sort of 80s were just dominant majors, and there was very few sort of private companies or small publicly listed companies that wanted to emulate some of the things that the majors are doing, and on that there had to be a whole lot of education in a space, in a market, a financial market that nobody understood, and they may understand how you produce it, but very few could understand how it's sold, and particularly if you came to bank finance, which was another issue. So I consider Dustin a friend, a great colleague, and one which we still keep in touch. And but his knowledge of the utilities worldwide is fabulous, and he's a good guy to have around.
Right. I second that. I've had some time talking with Dustin as well and getting to know his business, and I can tell you his resume is extensive, not just what we have here on the presentation that people are looking at. An extensive depth of the industry is absolutely impressive, and his knowledge of the fuel cycle is probably the most extensive that I've heard. Dustin's knowledge there is incredible, top shelf, and so really, if there's anybody who wants to know about the business in this regard, fuel cycle and the utility side and that stuff, Dustin really is a one-stop shop. He's really impressive on that. So we'll leave it there. Dustin, hold your comments on that. We'll get back to you for just a moment. But Dustin spends some of his time when he's not traveling to conferences and so forth. He spends some of his time there in Colorado. And John, of course, is in Australia. And of course, when John's not there, he's probably over in Africa, running around looking for value and doing some things. So John's in and out, but he makes his home in Australia there. And of course, Dustin, I think Dustin tries to get some time in the States when he can, but he travels a lot. And which brings me to my next question. Dustin, you're in London right now as we're on this call. So what are you doing in London?
Well, very briefly, Andrew, I'm the Chief Commercial Officer for a new entity called Yellow Cake PLC. And this has been in the works now for more than a year. And if you think of it along the lines of a UPC type business model, in other words, we're in the process of doing our final roadshow over the next couple of weeks for an IPO. But we'll be buying, assuming the IPO is successful, 8 million pounds directly from Kazatomprom, which is the world's largest uranium producer. And we've already set the price of that material. But what we're really looking at is again, kind of a preemptive strike where that 8 million pounds could have found itself into the spot market this year. But we'll be taking it in one major transaction and holding it for an extended period. And again, like UPC, we'll be selling shares in the company so the investors can get the uplift from the uranium price, which we think will be improving in the very near term. But the intent is to buy and hold. In other words, we're not going to sell that inventory, so it'll be held off the market. And in a presentation made by a senior member of Kazatomprom at the World Nuclear Fuel Market earlier last week, he said basically this creates a new customer and very large customer, because we also, under our supply agreement with Kazatomprom, have a 9-year option for each year to buy up to $100 million worth of Kazakh production at that time. It's an option on the side of in favor of Yellow Cake, so we can buy part of that, all of that. So again, the intent is to create an investment vehicle which is different. It doesn't have the kind of risk structure that, say, a junior miner would have. There's no permitting risk, development risk, financing risk. It is a pure play on the commodity. Not to say it's the only investment to make, but anyway, yeah, we're very optimistic. We've had very positive feedback from pre-marketing, and so we should know in the next 2 or 3 weeks if we will be successful.
Okay, no, that sounds interesting, and it'll have another question there that'll come up a little bit later in the presentation here about these funds that are holding physical uranium and how that's going to impact the cycle going forward. So we'll get to that in a moment. Well, I appreciate the introductions, guys, and good to know where you guys are at right now. So let's move in here to the next part. We've just got some brief discussion items I want to go through before we get to questions. So I wanted to start here, and this goes to both of you guys here on this screen here. We have I wanted to talk about just briefly how the sentiment during the last cycle compares to today, and I guess we'll go back to John on that. How does it look today in terms of the sentiment right now versus last cycle? And also, do you guys feel like there is an exhaustion in regards to where we're at today on the supply side? Has an exhaustion occurred in terms of the supply and more or less the end of the bear cycle?
Right. Thanks, Andrew. Well, I'm a sort of got a somewhat contrarian view of the market, and when you look at it and what's happened in the last 6 years, especially post Fukushima, and all of the sort of contributing factors that have sort of confused, if you like, who are going to be the players, who is going to pull out. There's been a huge amount of disruption. People are changing their strategies in terms of major companies thinking of withdrawing. Some companies faced financial collapse, and I think the price they exposed weaknesses that were already there, I guess, and we can talk about the Paladin one as well. So everybody's looking for the upside, but nobody wants to put their hand in their pocket in the downside. So nobody can see the upside really. As is in a boom, nobody can see the downside, or very few. 5% can see the downside. 95% see, a boom is continuing, and the reverse applies. So the issue is that every time sort of a major company makes a move, and irrelevant whether it's a good one or not in terms of affecting supply, all of the sycophantic juniors go out on their investors and they say, "Oh, look what X company has done. This is now the turning of the tide, and this and that's going to happen." And truth somewhere gets lost in amongst all the hype and and that sort of sheer believing that uranium must sort of improve. I think the upside for uranium is phenomenal. I think there are factors complicating supply very much. I think there are industry commentators, and some of them are voices in with the utilities that are coming out with sort of numbers, inventories, future supply outlooks that need very little new supply until 2028, some of it. And others are saying the turnaround will be in 2022, 2023, where maybe some structural shortages will be confronted. And so that's the range. And if sentiment truly changes, there won't be that spread of opinion. It'll all start to congest toward wherever that sort of new sort of revelation is. So I think there are a lot of good things that are meaning that sentiment is changing. Dustin said that whether it's a year or, for me, I've got a time frame that's maybe a bit longer than others, and my strategy is built to take advantage of that. And exhaustion, well, the exhaustion is that on paper, on simplistic look, you say that supply is coming down continually, there's demand is going up, and and it still doesn't seem to have hit a brick wall. And I like opaqueness, because opaqueness means that others don't see where opportunity lies. But I don't think there's a clear tunnel yet in terms of there's the real catalyst has come, but there are many little signs that are in combination contributing to that the fact that there are troubles, and then there are opportunities, and yellowcake is one of those that is indicating that.
Okay,
So
John, one more question for you, John, real quick, on the sentiment side. How does the public today versus back during the last cycle, does everybody hate nuclear more or less today as they did back then? Is it a similar situation as far as the public view?
Well, I think whether the public like uranium nuclear or don't like nuclear is almost an irrelevancy. And I say that the first great grand nuclear period from 71 to say 2000 was done in a backdrop of a Cold War. Everybody was frightened, worried, and yet the inevitability of sort of needing this new baseload power proved more expensive than coal, and but it happened, and I think the same applied in the sort of 2005 to 2011 period. The antis were there. People think that if there's these people bleating fear and opposition, that seems to have some profound effect on the nuclear business worldwide. Yes, in Germany, that sentiment is been there for a very long time, and they've always been sort of weak nuclear participants. But sentiment hasn't changed that much, I think. I think you still get your sort of 40% antis, in some countries 55%, some are pro 70%, and it just varies.
Right, absolutely. Switching over there, Dustin, what's your take on what we just discussed?
Yeah, I agree with John. I mean, obviously anyone who's been in the business for a long time, we've seen the ebb and flow of, let's say, sentiment in general. I think the uplift this time will be a bit different. I think certainly on the investment community side, they all got excited, 04, 05, 06. There were 400 to 500 junior companies that were claiming that they were going to develop mines. Obviously, outside of Kazakhstan, Paladin was the only successful company. And so I think, let's talking just on the investment company side, there was a learning curve that a lot of the investors went up, which proved or perhaps revealed to them that this is a difficult business. And there were a lot of companies that never made it. And as John says, as now we're starting to sense some change in the wind, there's a number of companies jumping up, claiming they're ready to go. But I think there's still that skepticism. Do they have all their permits? And we'll get into it eventually here.
Sure.
Do they have the right people? Without the people, it's just nothing but idle discussion in my mind. But yeah, regarding the market, I know John is a bit more circumspect. I'm seeing some things going on. Again, the long-term market really is what kind of masked the situation post-Fukushima, because producers were still delivering at prices well above the spot. And keep in mind, this business runs on term contracts. Each year, and when you really look at the volumes in the spot market, it's averaged just under 50 million pounds a year over the last 10 years. And less than 20 of that is acquired by the utilities. So it's only, between 10 and 15% of global uranium requirements is transacted by let's say the primary players, and the rest of it are the financial guys, the traders, the brokers, the investment groups that create that what we call churn. And so, to me, the key is when do the utilities come back in to sign the longer term contracts? They've not been doing that because every time they look at the market, and let's say starting in 2020, they see prices significantly above the current spot. And by that, I mean $40 plus. And they just have not been motivated because they didn't see the supply cutbacks. And I think, an important thing are the bigger producers, putting mines on care and maintenance. And that's really, again, sending that message. On exhaustion, I guess you're kind of referring to mines that have finally, reached the end of their life. I mean, I guess the big one's Ranger. There was going to be 3 deeps. There was, all kinds of things that might extend its life. Those aren't even discussed anymore. And I think, John, I think knows more about this, but I believe they're supposed to be out of there by 2026. And so they'll really halt any processing by 2021. And so it's really gone. The big issue now is Rossing. If the market doesn't improve, there won't be economic support for a mine like Rossing, another large historic producer. So we are, the Rabbit Lake mine in Canada is pretty well done. So I think this is starting to seep into the market. And that's what exhaustion from that standpoint is taking on, reality. So, at least that's what I'm seeing.
Yeah, no, that sounds good. And yeah, exhaustion too on the investor side. I think at this point, exhaustion is pretty much hit from the look of things from an investor standpoint as well. So that's good. That's good stuff. So now moving on with some stuff that we just discussed, the concern for talent. We touched on that. You guys know a lot better than I do that there's a significant lack of talent in the industry. And I wanted you guys to touch on that from both a publicly listed company standpoint and also real talented people that are actually in the industry, people that have knowledge of the fuel cycle and people that can do the things that Dustin has done and the stuff that John has done. I think there's a real concern for that. So John, can you touch on the talent and the lack of and so forth for us?
Yes. Look, I think when you look at the talent and the lack of it, and what I mean by talent in a to get a complicated sort of industry going, you don't need just one engineer that knows about uranium. To get an airline going, you don't need you need more than just one pilot. You need a whole system. You need a whole understanding, and a whole interactivity of a whole lot of skills that have to fit in to a corporate ethos. So when you look at from Chernobyl and the uranium sort of devastation in terms of companies going bankrupt, companies rationalizing, people leaving the industry, the only place where people didn't leave the industry was actually in the back end, in the nuclear reactor side, in the fuel. But in the front end, in the mining side and the exploration side, this was absolutely devastated. And so post 1990s, there was hardly anyone coming into the industry, young people. And those that were in their peak at that time, in the sort of 50-year-old, they didn't exist by the turn of the century. And so you have a whole bracket of expertise that was basically lost. And not only just that, but whole databases, academia, where almost every university had a nuclear department and particularly a uranium sort of research in terms of ore bodies, in terms of all sorts of things. So that degradation meant that when the next cycle came around, which was let's say the Asian sort of lead boom, or China, it was really apparent that there was hardly anybody that knew what they were talking about in terms of running these 400 companies. They were just learning on the trot. They'd read their 101 uranium book on something and put out a lot of these fascinating statistics which only uranium has to offer, and people would be sort of impressed, but really they had no fundamental knowledge of what it took to how to work in the uranium world, how the care you need to take, stakeholders, and a whole set of responsibilities, and technical as well. And clearly that's shown out by the 400 companies that promised the world, and it was only Paladin in that sector, in the listed companies, emerging producers, that effectively became a large capacity producer. So come now the next cycle, there's a bit more expertise around, still very much, and not a lot of it is blooded in a corporate sense in terms of building a mine, having a brand that can impress governments, that can impress the IAEA in terms of your responsibilities, and all of that understanding of what it means to participate in the sort of global supply family. And this is structurally a huge problem in companies today. So much so that I believe that utilities still count deposits as production. The whole thing for me is I look at future supply through the lens of capability and who's going to get those deposits going. And when you appreciate that 60% of the efforts to get a mine going from 2005 onwards, when Paladin started, only Paladin was the only company of the two of its projects reached nameplate. So there's a flaw there, and nobody's taking any notice of it, and particularly the UXCs, trade tech to a lesser degree, where they just think, here it is, here's the deposit, and we'll just, it'll just produce. And they're getting lower quality, so you need higher quality people to manage them. So yes, there is a problem with expertise.
So with that, John, one follow-up question. There's not any little Borshoff anytime soon that will be jumping into this industry?
Well, look, I wish there were, because I get asked by my board, for who's going to succeed me, and it's not that's, I mean, nobody's irreplaceable, but you really have to then get an expert in this bit of it or that bit of it, but that sort of overview and understanding supply and getting an appreciation where the opportunities lie there, and that more general network, you have to get the skill sets of 2 or 3 people and combine that into a management unit. I'm not saying I work as a single sort of post, but there are not many people around, and more. Dustin can more answer that objectively. I mean, I'm just always looking at that. I want good people, but I find them very difficult to find.
Right. Well, John, keep working on the kids, John. Dustin, what do you think?
Well, I certainly would support John's comments across the board on experienced talent. I think what we saw in the last uplift, I know certainly in the United States, there was a bunch of 75 and 80-year-old geologists that had worked back in the 60s and 70s that were available to do some work during that period. But now, as John said, we had a long march when the price was depressed. Nobody was hiring anybody, and certainly nobody had money to cultivate junior people. So I think it's a big problem, and I try to tell the utilities that keep in mind, as these companies come in and talk up their projects, that's fine. But the utilities need yellow cake in the can. there's a different strategy you have to use in discussing your company with a utility versus, say, a potential investor. And I think that's going to become a huge problem. I know when some of the companies have looked for replacements at the highest management levels, the list is extremely short. And I think it will be getting less as we move forward. And again, what I see is it's difficult for executives to come in even from other mining sectors. And they just say, oh, well, I mean, I understand this, and therefore I can just transfer that to uranium. As John said, this is a whole different commodity. It's the most regulated mineral commodity in the world. You've got as he said, the IAEA, you've got your local, I mean, it's just a complex situation. I think a lot of them then give up. They go, I just can't move this forward. So when one looks at the need for new production, it's going to be tough, I think, to get the right kind of technical, operational, you run down the list. Yeah, some of the areas, maybe finance and accounting, you don't have to be a uranium expert, but in a lot of the operational areas, there's no question that, it's a different situation. So anyway, I see that as a very looming challenge, let's put it that way.
Right. And you got a lot of issues, whether it's the local culture, speaking the various languages wherever you're at. It's certainly not a place where you can sit at an armchair at a desk and get something done. You have to have a whole system of expertise. Absolutely, I agree. Well, Dustin, continue to work on the young people, including those in your own family, and hopefully there'll be some hope for the future talent there. On the supply demand side, here at the bottom, I'm going to skip that because we already kind of discussed that, and we've got more questions related to that later. So I want to go back to, I'm going to stick with Dustin here for just a moment. Dustin, you do consulting for a number of publicly listed and private companies in the space. What strategies have you seen that would create value for these companies, and what strategies have you seen, some strategies that just aren't working?
Yeah, well, obviously I have to be fairly careful here, but yeah, I've kind of designed my client list, and it includes Bannerman, Energy Fuels in the United States, and up until February also Berkeley with their proposed Salamanca project. Each company's in a different geographic region. They're in a different, place in their progression as a company. And so I think, strategies have to be developed for, there's no one strategy that, fits all. Bannerman, they're very early. They've been around though for, 10 years, have done a lot of work evaluating their project. It's a bit more costly than some others, and they realize that. And so, they're, I think, doing what's appropriate for the current state of the Etango project. They don't have a big staff because the market hasn't called for, production out of, a project of that size, and kind of in that cost category. Berkeley obviously is a bit different. They've been around for quite a while, and what really happened there was the geologists, discovered the new deposit, which really changed the economics of the company. Yeah, I was just out there a few weeks ago, and they have some very interesting results. They are looking to initiate construction. They've raised money from the Omani Sovereign Wealth Fund. They have a couple of contracts in place. So they're in a different part of the, let's say, of the industry than, say, a Bannerman is at this point. And I think, they're trying to make the decision to finally pull the trigger on construction. And I think with the improvement in the market, that's likely to move ahead fairly soon, recognizing there's always challenges. And then Energy Fuels, they actually have in-place production capacity. They're in production. They have the conventional mine mill component through the White Mesa Mill, the only operating conventional uranium mill in the United States, and I think only one of 3 that still exist, maybe 4. And they also have 2 ISR projects, one in Texas and one in Wyoming. So they have a diversified production, capability. So they're a little different on their strategy. Theirs is more focused on getting some contracts fairly near term to keep things producing. So it's hard to say, well, is one strategy better than the other? A better market would help everyone, but they will come to market, based upon the status of their ability to produce.
Right. With all of these companies, if you look out from a macro standpoint, they're all at different stages along the life cycle, really, of these types of businesses. Of course, some of these have been built over many years. So there's the underlying strategies for now. There's the overall game plan to grow a company from a drill hole in the ground to a producing company who's distributing cans of yellow cake right to the ports. John, with that in mind, strategies and characteristics, the first 2 points there, what do you see with your past experience of success there? What do you see are some good strategies and characteristics of a company like what you did at Paladin?
Look, firstly, just to touch on a little bit on the strategies to create value. I think where opportunity lies is where few people are, and most of the companies that are around and in that sort of hopeful category, with their sort of signature deposit, of which they're putting all sorts of polish on it and trying to get it developed or trying to get it ready for development. What it does say is that there's extreme crowding of hype, crowding to be differentiated in amongst probably about 12 or 15 companies, and there's no way these are going to all come together, and there'll be some real heartache in amongst all this lot, because they're going to rush, they'll get contracts too sooner, they will prepare the road for other people when the price really does come in. So you've got to stage how you enter into the supply business. Junior companies that dream of £7 million per year. Well, enough said. I won't say any more here. But so what I think the strategies are is to assess what the climate is, what the environment is, where those opportunities are, what is seriously missing in the supply sort of companies, and how do you fill that vacuum? And very few companies are thinking about this. They're not thinking about consolidation. They're not thinking about what's needed when major companies are exiting, and they're just very much inward looking, and really, I feel, don't understand the dynamic of the whole changing supply. In terms of characteristic of what makes a good company, I think in a uranium company is big, deep, wide knowledge of nuclear and uranium itself. So deep that you can give confidence to the stakeholders, to the communities, and that you have a brand that is like stainless steel against rust, against people that always are deriding the business, always trying to put fear in your shareholders, and then a culture of that trust your commitment is your word, and your word is you'll do it. And I think that's what Paladin does, and this is what I'm trying to engender in Deep Yellow. And also to be a company that demonstrably is able to produce in the category that it is after. It has a proven track record. It's not promoters or hopefuls, and which is plenty of room for all that, because the time for exiting, like in the previous period, and selling for high premium is gone. There's nobody there. So these companies are even more vulnerable, and expertise again will come down to that word of building, and that that people that are associated with you commercially believe that you will deliver on a commitment, which is so important in the nuclear industry.
Right. I agree. You need all the personalities need to show up to the party. So that makes sense. So moving on, back to Dustin here. So over the last 2 years, you've had various supply cuts. You've had new funds, trading houses, stockpiling funds have been set up, and things are starting to get stockpiled, and new fundraisers have happened for more physical uranium stockpiling. And you've had the shutdowns from the Cameco and the Kazatomprom. Dustin, to you, what should a retail investor look for now? What straw should they look for now? What's the next thing to come in your view?
Market-wise, I think if we don't see the price improve, we'll see more shutdowns, and it won't just be guys, let's say at the margin. It's going to be very, large production sources, and I can pick on a Rossing that there aren't a lot of them left. Let's put it that way. And that's one thing I know John has touched on is consolidation. This business now has you can count them almost on one hand, a number of large producers, and they have their own strategies. I mean, BHP will kind of forever produce uranium as a byproduct, but they're not going to expand that, outside of an Olympic dam. Cameco, has made it very clear that they've pulled in their horns. And people seemingly don't listen when they talk, but they said they're not spending any money on any of their other projects, like in Australia. Yeah, they've moved them to kind of, they had initiated permitting, so they might as well kind of finish that up. And, the replacement for Cigar, it runs out of ore in 2028, and it's a discrete ore body. It's not like, say, a Langer Heinrich, where you can do more drilling, and if you, kind of know what you're doing, you discover more pounds. They have to develop like a Millennium, and they're not putting any money in. So I think, the investors can take a look at that. And then on top of the juniors, a lot of them, are out telling a story of how they're going to be in production. I saw one today, and I won't name names, of, they haven't even done a feasibility study, and they're going to be in production in 2021. And I mean, I'm sorry, but that just doesn't work. A lot of them require huge capital, some of them in the Athabasca, which are going to take, probably 8 to 10 years, even if they started today, with a much higher market. They require more than $1 billion in initial capital, which is a little hard to raise these days. So, the other thing is, unfortunately, the market, everyone watches the spot price. And as I said, that's a bit of a tail of the dog. But if that, starts to firm, then I think, rather than a false start, we've seen, like in November, the price went up a bit based upon MacArthur announced shutdown. Cameco had not initiated their buying component of that in the spot market, so the price sagged. I think, probably second half of this year, they should keep their eyes on, again, the spot price will be one indicator, but also as hopefully there's term contracts signed, which we do have some utilities, I think, seriously looking at that term market starting in 2020. and will have to just swallow hard on prices north of $40. And when I think that starts to get reported, we'll see a real change in sentiment in the market.
Okay, yeah, great. So on the last question there, 2019, 2020, 2021, people, some of these folks are impatient and they can barely hold a trade over a weekend or at least 2 years. So they get impatient, they get tired. For you guys, in your view, just give me a year for a person who is going to get in there and look at some of these publicly listed companies to play this cycle. Honestly, right now, my opinion, I'll give my opinion here. I think we're at a 2019, a 2020 type situation for real move. John, do you have a year roughly? And Dustin, do you have a year? John, let's start with you.
Look, I'm because of the strategy that I have to sort of, I've got my opinion in the sort of 2020, 2021, but I have to act as if, the prices may move in 12 months' time, and my window is the period at which there is despondency in the business, and opportunity arises. But if you believe the WNA and they say that the supply, there'll be a supply shortage post 2023, and if then that supply shortage post 2023, in terms of people wanting to seek term contracts, is not really coming into effect by 2024-25, where that deficit is truly met. And if you say that the price response is 2 to 3 years before the shortage, because term contracts start touching into that period, then you're looking at 2020, 2021, and the whole thing for me is that there is so much misunderstanding. It's miserable how little the utilities know and appreciate what supply is and how much supply, and that supply for dozens of years came out of 5 main producers. And then you're going to get this whole ragtag of 20 new producers, which in itself presents risk when you get people that haven't got expertise. They're running companies, they've got dreams, they're doing this, they're overcommitting in terms of how much their little ore bodies can produce, and you have another risk. But these problems won't be recognised by utilities until they happen, and so there'll be exacerbation. But I'm a long way around saying, end of the decade, where I see real serious business happening. I can see, for instance, Cameco seriously underestimated what the issues were, having put out a marker out there, sort of shutting down MacArthur for 10 months, and saying this and thinking that within this time frame, the utilities will shake in their pants and everything would turn, and then they'd fire up MacArthur. No, it's not simple. It's complicated. It's opaque, and it's darn difficult. And there's been drastic announcements. Some of them good, some of them not so good. Half of Kazatomprom's announcements are smokes and mirrors. They haven't been real shutbacks like Cameco has done. And but look at the spot price, and you will not see the event of any of those things happening. There's a bit of a kick now, but when Cameco did the cutback, it went to $25. Little orgasmic change, and then back it down again it came. So where is the fear? Where is that real catalyst is yet a long way away, I believe.
Right. Dustin, I was going to ask you, what do you got? Give the retail investor a year.
My view on it. Yeah, I don't.
Sure.
I'm a little earlier than John on this. I think what we're going to see in the spot market is if yellow cake is successful and we take that 8 million pounds out of what could have been in the market, there are also some other funds that are in New York that are looking to start to buy some physical material. But a big thing will be Cameco buying, and I think they've made it pretty clear they're not going to come in the market and buy little dribs and drabs. They're going to buy big volumes, and apparently internally they're talking about MacArthur won't come back on till the price is 40, and that's evidenced by new term contracts kind of at that price level. So I think we're starting to see, a number of factors that will come into the spot market. There's a lot of talk about massive oversupplies from the Russians. I was told recently that that's not the case, that they remain short starting in 2020. So there's not a lot of material that they're introducing into the market. The Kazakhs gave some more production cut numbers in Monterey, which I think they were willing to fess up that trying to slow that country down has been difficult, but now I think they've gotten gotten a hold of it a bit better. So all of that put together, I would be surprised if the price isn't better at the end of the year. Let's talk on December 31st. Into next year. So I'm kind of, late 18, certainly into 19, we could start to see a better market. That doesn't mean it's $100, but I think it's certainly going to be up from 23 and hopefully have a bit of support under it. Because I agree with John, these things are announced. Everybody kind of does, gets a little excited and it drops back down. But just to talk about the utilities, which we haven't touched on yet, they've made it very clear they react to the market. In other words, you'd like to think they anticipate, but they really don't. And the market will, quote, tell them when to start contracting. And so far that hasn't happened. So anyway, we'll have to wait and see.
Great. So let me change gears here. We're gonna do a few questions from folks who submitted them. So I want to say thank you to Steve C, Bill R, Jared W, Paul M, Levi B, Mike P, Todd A, and Dave V for your questions. Thank you. This one to Dustin. Tell us, Dustin, we're going to go to underfeeding. With underfeed supply, do you see it as a cyclical situation, underfeeding? Does it have to do with the overall big cycle of the uranium cycle from up to down? And then what would you, in your estimation, have for a number of underfeed supply that is actually entering the spot market?
Okay, happy to comment on that. Obviously, it comes up frequently. Underfeeding has been taking place for decades. I came across a paper recently in one of my dusty old files from 25 years ago, talking about the effect of underfeeding on the market. So it's nothing new. And again, it's an operational strategy that the enrichers used, and certainly with centrifuge technology now, which all of the enrichment is based on that, they need to keep the centrifuges spinning. I've been told that if a Russian centrifuge is off for 24 hours, it gets out of spec. So as we got into the post-Fukushima period, what we saw was, first of all, the Japanese cut back on their not only uranium purchases, but also enrichment services. So the enrichers, in order to keep their plants spinning, let's put it that way, went to more underfeeding. And what that means is they just apply more of their service, which are separative work units, to a given volume of uranium to produce their output, which is enriched uranium product, which is what they're contracted to deliver to the utilities. But contractually, they've set a certain amount of uranium that needs to be delivered, in order to produce that EUP. But what they do again is they put more SWU in the process, and they're able to divert some percentage of the natural uranium feed. And so that's what's really been occurring. Now, again, the enrichment side, they've stopped building centrifuges. They've canceled some expansions. They're not replacing centrifuges as they wear out. So we will see some balance coming back. And the Japanese are starting to take deliveries because they do have to build fuel for their restarts, no matter how slow those might be. Anyway, the number that I've seen recently is between 6 and 8 million pounds of uranium for Western enrichers that's being generated out of underfeeding. Now, one conclusion is that's all coming into the spot market. That's not true. Again, the enrichers are in business to sell their product or service, and what that means is enrichers like Urenco, for example, just did a recent long-term EUP deal with the Koreans. And so they're not only bringing their enrichment service to the utility, they're bringing the uranium feed component, which they basically got at almost no cost. So they can be highly competitive with their EUP. I've heard that maybe, 1 million to 2 million pounds is being sold into the spot market by the enrichers, and that's just to cover some of their costs. But it's really, once the market begins to pick up again, you'll see less of the underfeeding side. And whatever the Russians are doing, my view is consider it goes into the black hole and it's not coming out until, say, they need to fuel those new reactors they just are contracted for in China or India or in South Africa. So again, it's going into their stockpile. So I think that, yes, underfeeding is an issue. It will be around for a while, and it may always be around. I mean, it's a way to balance the enrichment production versus the uranium market. But that's basically what I'm seeing on underfeeding.
Okay, so let me just continue with just a couple more on this issue. In a rising price environment, say a uranium price of $60 a pound, does the potential for underfeed supply, does it increase or does it stay the same regardless of price?
Andrew, theoretically it increases. If there's excess capacity in the SWU side, they want to save some of that uranium and therefore monetize it. But I think what we're seeing is, again, the capacity, the SWU machines are all operating. So, if we move forward and there's a better balance, just so you know, Urenco builds SWU capacity after it's been put under contract effectively. So they don't anticipate new markets, they react. And the only thing that got them was Fukushima because the Japanese backed out of their SWU commitments. So it's not anticipation. It's after they get it under contract.
Okay. And then with that, the underfeed supply, the numbers that you gave us, do you see that continuing for the foreseeable 2, 3, 5 years?
Could, but I think it'll start to work its way down. Again, they won't replace enrichment capacity as the centrifuges reach the end of their useful life. They're not building new capacity. There was a lot of discussion about expansions and all of that. So I think, it will start to work its way down. And so that 1 or 2 million pounds might become 1 million. I mean, it becomes certainly less of an issue. Let's put it that way.
Okay, that sounds good. Lastly, give me a single source that retail folks could go to for this type of information that is relatively credible. Is it Urenco, or where should they go?
Like many things in this business, there's no Google site you go to. They can, John referenced the WNA, they put out a market study every 2 years, and there is a secondary supply section in there that talks about, one of the issues is underfeeding, and it's available at a modest cost. But that's about it, unless they subscribe to one of the consultant studies, like Trade Tech puts out an annual enrichment study that goes into
Sure.
this issue, but there is no credible, no-cost source.
Okay. Okay. That's great. Thanks for that, Dustin. John, switching over to you for a question here. During your time at Paladin, John, give us a few people, if you can, at Paladin and outside the company that were key people to delivering your view.
Well, if you take it in sort of 2 or 3 parts, in the period from '98 to 2002 and 3, there was nobody. I was just on my own, believed my own pitch, and the industry was dead. I mean, you could pick up a $2 billion property at that stage for $15,000, like I did at Langer Heinrich. So there were people before, when I worked for the West German group that discovered chelate, and they had a great influence on myself, both on the technical and commercial areas, and then moving on. Dustin was a great help and a confidant, and we strategized a lot in where Paladin, what it could make up, how it could integrate a supply side marketing arm, and all of those things, which didn't invest to sort of eventuate, but at least we talked about it and some of the benefits of this and how it could work differently. On the other side, there have been engineers, a guy called Daryl Butcher, who we innovated new innovation in Langer Heinrich and Kayla Kera, which not only do we develop 2 mines, but these mines have got completely different processes that have set standards for future production. My chairman was great with his sort of chair stewardship. Gillian Swaby, who's worked with me for 20 years, with her black and white view on life. So it was a whole combination of people that got together, were disparate, independent, had their own thinking, but amongst all of these people, there were no yes men or women, and that, I think, is vital.
Right. Okay. Well, thanks for that, Dustin. Going back to you, you and John worked together for a long time, almost probably a decade, from what I see here. What conflicts did you and John have, and how did you both benefit from them?
Well, keep in mind, we're contemporaneous veterans of the business, so I think we saw a lot of the same issues in a similar light. And there were no, deep-seated conflicts. And I think that's where John did a really good job of bringing together, a group in management that, had their own opinions, but like he said, weren't any yes men, but we were all trying to get to kind of the same objective. And so, would we go back and forth on pricing? John, I think you might, agree that ceiling prices, the utilities, if you do a market price contract long term, they'll give you a floor price to kind of protect you. At one point, they were like $30 or less, so they weren't worth much. But they also want a ceiling price, which protects them on the upside. Now, this has been a commercial term that's been around for literally decades. And I think that's one breath of fresh air John brought was he goes, wait a minute, there aren't any other commodities where the producer will put a lid on what the value is. And so, we kind of, we went not around and round, but, it was a point of discussion of, well, that's what the utilities want. And again, John brought, that, and John, just so you know, and we'll talk about it some other time, I think the view of the utilities as just customers, which is kind of now permeating the business. It's not a gentleman's club. It's not your buddies. You might play golf with them, but I think it's more of a, hey, there's a lot of different stakeholders, and that's all got to be put into the mix. But yeah, I think a little bit different view at times of the market. Sometimes he was more optimistic, sometimes he less. But yeah, other than that, there was no knockdown dragouts that I can remember.
Okay, was there a disagreement between what brand of wine you guys were going to have, or what microbrew you're going to have at the bar after work?
No, I left that up to John. He knows the red wines a hell of a lot better than I do. So anyway.
So,
okay.
Just to
John.
follow up a little bit on what Dustin says, people, look, I can be as sort of hard and as aggressive as the next guy, but I don't believe that creating that sort of tension in a group is necessarily the one that breeds the results. And when that question arose, when you just said it, and I thought, gee, we've always sort of argued our cases, but there was never sort of conflict in our longer objectives, and thereby everything was geared against that objective and how to get. But look, if there was any conflict, we wouldn't have survived in those tough years where when it is tough, and when you've got weaknesses in your group because of politics or underlying sort of conflicts, pretty soon it's like rust. It destroys your whole group. And we certainly went, and we were weathered against that, and we really withstood anything. So conflict wasn't there. There was with some other people, but definitely not between Dustin and I.
Oh, good. Okay. Well, hey, we're about an hour and 10 minutes in here. We're going to continue and try to get through this and not take everybody's too much of their day up here. So back to Dustin. A quick question, quick response for you, Dustin. Cameco and the Canadian Revenue Agency have a transfer pricing dispute. Do you think that has any impact on the market?
You could view it that way. Again, there's all kinds of opinions on that dispute, and I understand exactly how they put that together with their transfer price, with the Swiss company and the like. Not knowing anything, I think there'll be a negotiated settlement, because this will go on for a protracted period. But what it does, I think, is let's just say it's an issue that certainly Tim Gitzel and Grant Isaac and they all have to deal with. And is it hindering their, say, acquisitions or investment? Could be a little bit. I mean, it's a very big number. I mean, obviously, if it went against them, it's a big drain on finances. But again, I think it's one thing out of many that they're dealing with. And, the IRS settled, and, it's just something that's kind of ongoing, but I don't think they'll let it go on for another 10 years.
Right. Okay. No, that sounds good. And John, back over to you. For those who aren't familiar, explain where Deep Yellow came from and why it was set up. So why are you back with Deep Yellow, John?
Well, there's two reasons for that. First of all, when I was running Paladin, when we were starting to build our mines in 2006, it became clear that we couldn't devote that much time to exploration over the next sort of 8 to 11, 12 years, and which happened to be then true. And I needed an exploration arm that was running independent but had some sort of association with Paladin. So we helped form Deep Yellow, and Paladin formed Deep Yellow. It retained a 20% interest in the company. Sometimes went up to 23, 24. We had a director on that project, on that company. and always Deep Yellow worked around the main areas. Deep Yellow worked around the main areas where Paladin was. So I knew the company, I knew the projects. And my team had different opinions in terms of how well that ground they held was being exploited. In fact, tried to joint venture with them, but that didn't work. And so when I left with sort of mutual understanding, left Paladin, and after about 8 months, thought, okay, we need to do something. I looked at about 8 companies that for me, which ones would offer the vehicle that I could take and do a Paladin Mark II. And it became really obvious that, apart from my familiarity with Deep Yellow, and I knew that there was no sort of strange ghosts in the cupboard, it also had a very clean register. And one thing you find after the sort of a Fukushima, a massive event, you'll find that the shareholdings of companies become compromised as they try to survive, either with private equity taking large, some might say too large a hold, and controlling Chinese investors coming in. And so Deep Yellow for me fitted 2 reasons. I had a clean company with a general sort of a shareholding, and that Paladin had an interest at that time about 9%, 10%, which I knew I could take out. And so I effectively had a company that I could put at the beginning of the runway and had all that strip ahead of me to take off, where I believe most of the companies have matured, hadn't taken off, and were already 3/4 of the way down the runway and not off the ground. So that's simply why. And they had some good ground in Namibia as well.
Right. It's clear that you know both yourself and Dustin. It's clear that you guys aren't back here for the money for this last cycle. But John, continuing with that question, answer this one. This one was interesting. Was the equity performance of Paladin a rare chance, or was it a reasonable expectation of yours to have that outperformance during the last cycle?
When the Paladin share price was 8 cents, I had it was a 8-step event where I predicted share price in the market cap, the events that would create that, and on a share price, and I got it up to $4, and and so I really believed that if we got this together, the outcome was assured. There was no question. We were sitting there. We were virtually on our own. I felt that against the others, or the Canadians were basically prospectors. They were just, out there, good-hearted guys going and drilling their heart out, which is great, noble, but it doesn't make companies on its own. And so yes, I didn't expect it to go that much, and in fact, there's very few companies that have replicated that increase, as you know. But 1/3 of the way I'd predicted in value.
Very well, very well. So going back here, I'm going to go back to Dustin here real quick. Dustin, do you believe that companies need to pursue utilities to get contracts and their attention? So do companies need to pursue them, or can companies build value and just stand there and wait for people to line up?
I'll try to keep this brief, but this is an area that I clearly focus on is term contracting, particularly with the utilities. Yeah, I think the build it and they will come. You really need that relationship with the customers early days. And this was one thing I'll give a, positive shout out to John. When he and I talked initially, he recognized the importance of marketing in this mineral commodity. The utilities are kind of a strange group. They vary markedly between regions, within regions. And I think, a lot of the current juniors, as he said, they've been optimizing, which is good, but then they run up against the wall of term contracts. And I think, we could spend quite a bit of time talking about how those are put together. But I think you need to engage your customers to know, kind of at this point it's a buyer's market. So, you're going to have to listen to everything on their wish list. Hopefully we get into a balanced market. And then at some point we'll get into a seller's market. There are various issues that the utilities have to deal with, and their procurement has changed. It used to be the nuclear fuel groups were kind of left alone internally to cover their requirements in the best way possible. But anymore, you've got to go through risk management, treasury, finance, and there's all kinds of internal hurdles for the fuel managers. I've had these discussions recently where their jobs have become, even as John said, they're yet to really recognize the supply issues that are looming, and that'll just add to their list. But yeah, you've got to get out and beat the bushes. You've got to go in and talk to them, let them know what your story is, what your plans are. Because again, they want yellow cake in a can. And for them, there's credibility. Will you deliver? They don't care what your share price is. They don't care what your blue sky is. That doesn't put, yellow cake in their fuel cycle. So the answer in big bold letters is yes. Now, of course, there's degrees to that. Do you go to Mumbai every quarter to talk to, the Indian Nuclear Power Corp guys? Well, no. But there's some that are, you've got to prioritize, and so, that's kind of a long-winded answer to, absolutely. You've got to understand your customers.
Sure. And with that, continuing with Dustin there, Dustin, what, in your view, what single notable project do you believe will be commissioned first in this new cycle?
Well, again, I have to be, I've been fairly careful in choosing my clients, but I think, Salamanca, it's not massive. It's, 3 to 4 million pounds a year. I think, again, with their couple of good term contracts so far, the funding from the Omanis, which doesn't require a lot of term contracts, unlike, say, a bank. And, again, I think the proof will be in the pudding if they make the decision even before the end of this year to start construction. But, other than that, and I think John, has his views, probably aren't a lot different. There's not a lot of really viable projects until the price gets up, pick a number, 50. This whole idea of, well, our cash costs are this. Well, you can't develop any of these projects if all you get's your cash costs or a break even. Well, I don't think investors or board directors are going to say, well, yeah, let's pull the trigger at a break even. That isn't going to happen. This is a risky business, and they've all learned lessons during this last cycle. So you want to have a margin in there. Again, this is what I'm trying to tell the utilities. Don't get enamored with, 43101 C1 costs. I mean, give me a break. Because they'll say, well, if your costs are 18, I'll give you 20, and you ought to be able to move forward. And of course, the comeback is, well, I really need 40. So anyway, kind of that's what I'm seeing on the project side. There's just not, everybody's looking at acquisitions, and there's not a lot of attractive projects in the hopper at this point. But John knows more about that than I do. So,
John?
Yeah, so look, I see great difficulty of who's going to initiate with the substantial production, and I think Berkeley, yes, I think it's still got issues. I think there's a lot of risk, technical or risk in terms of. I've always said any country in the EU to have a uranium mine, you've got to bump up the factor. And but they've got the money, they've got the heart. I think too many people will rush. I seriously believe that incentive pricing has to be above $60, and everybody, this nonsense. I fully agree with Dustin. This nonsense about what my C1 costs are. It's the all-up cost, and Trade Tech have done a wonderful analysis of this in the uranium space, and looked at the whole cost, right, the C3, and you see where the numbers are coming in. And when you look at replacing reserves, what you need numbers. I believe if people start at $40, I'll wait for that other opportunity, acquisition opportunity, that in the long term they'll suffer.
Right.
Costs are very, very high. Deposits are low grade. You find somebody that's got deposits, and you say, I'm running out of 5, 8 open pits, and I'm going to do my operations. Really careful. And this is what I'm saying by crowding. Everybody's crowding, so they're competing on a C1. It's about as useless
Right.
as I don't know what. And it's not a number. It's not a sensible number. It's not any. And Cameco saying it's got it's cost at $20 or whatever it might be. What are the other costs it's got? They're much higher. Kazatomprom saying $16. These are running, when you look at all their costs, they're running $21 to $35 a pound. Nobody talks about that. It's just the high banner processing costs. No mining equivalent cost or well field cost. It's a really immature, poor industry that can't afford to tell us real cost structures.
Right.
And
hey, I got a question. I got a question for both of you here that goes on with another separate issue, just to step out. What you guys were both in Vietnam. What wartime experience did you guys both have? And we'll go with John first. What experience did you have during Vietnam, John, that has helped you shape and craft your expertise and your business likings?
Well, I'll preface everything to say that my Vietnam experience was one of the most amazing experiences for me, and it was a changer. It brought out the best and the worst. I saw people that you can't predict what they're like until you see them under pressure, and trying to in real life, trying to estimate that through pathetic HR sort of interviews is just doesn't work. I saw what it's like to protect your mate, and they do the same, and I really believe the best thing that I learned is controlling fear. So, and everybody's afraid, but just that you could go that extra yard, you could do more than what you believed, and when you test it to the fullest extent possible, you realize who you are, you realize where your strengths are and weaknesses, and that's what's taken me through my corporate experience.
Dustin.
Yeah, I would certainly, like I said, echo John's comments. Now, I was fortunate enough to be in the Navy officer corps, and I was not in country. In other words, I was on a ship that was in the combat zone. But what you learn, certainly from my perspective as a 22, 23-year-old ensign, is, teamwork. As John says, you rely on your mates, and that was the other officers as well as all of the enlisted guys on the ship. Try to keep calm under fire. We had officers that couldn't do that. And then there were those that, when the shells started coming in, we're able to kind of maintain that, let's say, more clear vision of what needed to be done. But again, it's that group working together for a goal or an objective, which was crucial in the combat zone, even on board ship. I mean, we did 98 underway replenishments. So you have to come alongside a replenishment ship. Everybody's got to work together to get it done as soon as you can. You run down the list. So anyway, I think that now it was run under, kind of an absolute structure where, the captain's word was what you did. But still in all, I think for, as John said, this, has carried me through my career that, kind of calm under fire, I think is probably one of the more important lessons that I learned, certainly.
Right. Very well. I like that. What for both of you, Dustin, back to you for a moment. What single greatest mistake did you make during the last uranium nuclear cycle that you would like to avoid this time?
Oh, I think, John would have his opinions. I think post Fukushima, which was certainly a black swan event, I think we had a view of the future that, was based upon the Japanese response being much more rapid. That this wouldn't last. Even, Gitzel Kamiko said, who thought that the effects of Fukushima would last 6 or 7 years? And maybe part of it would be to, cover off with term contracts that would provide a bit more support. But, and John can comment, we wouldn't have been covered probably this far out. We would have been amongst this group that's kind of having those contracts drop off because was the nature of the market. And, so I think that was it. It was an event that who knew, how long this would, and the depth of it, the fact that Japan would not turn its back, but certainly back away from nuclear for as long as it has, and, has resulted in these market effects that are still being felt. So I guess that might be it. I don't, of anything.
John?
The mistake that I made was built around the objectives we had in terms of getting Paladin in 2006 producing no pounds to in 2012 producing 8 million pounds, which was then about 5% of the market. And that involved making 2 operations, 3 expansions, and we were continually in development construction mode. And we couldn't have achieved that without debt. And so we had a considerable amount of debt lying with us to get there. We couldn't do it all with equity. And I guess the mistake was that when Fukushima happened, that instead of, like Kamiko, believing that this would turn around in 3-4 years, we should have immediately acted and reduced that debt. And that for me was a big issue. The other one, of course, was I sold no shares until $10, and I wish I'd sold some more than I had. That's all. But that's
right.
Nature.
Right. So, yeah, I think when you have an issue, if you have a substantial event like a Fukushima, it's tough. You can certainly plan for types of things like that, but it's one of those events that is very, very hard to be able to recover from. It's a difficult situation. But looking at Chernobyl, 3 Mile Island, Fukushima, that spans many decades, and so it's an interesting situation that exists with the time frames.
Well, the other thing I'd like to mention is that having increased their production from 2007 to 2012 to 8 million pounds, we had a constant problem. Unlike all all the other producers that existed that had flatline production, Cameco's, Ranger, ERA, Rossing. So they'd all built their term contracts up to 70% of their production.
Yep.
And because that had evolved over years and it got to that steady state, we always had to get the nameplate before we actually committed and tried to make term contracts, so that we didn't have our full quota. Well, I think we got to a maximum of about 40% to our total production. So we were exposed then to spot as a direct consequence of the remarkable achievements we did, and that's when I got a real problem with some of these young companies coming through. They say, oh, I'm going to get to a production of X, and you've got to be really careful what you commit in long-term contracts, and how you commit and how much of the production you commit, because if you don't deliver, you're lost meat. I mean, you're not. That trust of delivery is really an important part. So there's many factors that we were aware of. We did, and that event. I mean, the reason I'm really sort of think about it, and I've learned a lot, is it wasn't that the event occurred. That's fair enough. I mean, it's bad luck. But if I'd had, if thinking back, and the power of hindsight is to have had a disaster management sort of idea to say, look, if this happens, we need to offload in the next 12 months or whatever it is and drop our debt, and some sort of action. Whereas we were believing that, oh goodness me, it's going to be 4 years and we're right. Anyway,
Right.
That's story.
So I want to switch gears for just a moment here and take a look at something else. So hypothetically, Dustin, this is for you first. Hypothetically, Dustin, if you had $100 million and you were the CEO of ABC Uranium Company, where and what would you do with that money? Give us a jurisdiction and tell us what you would do. Would you take a mine that was existing and try to build it, or would you go greenfields? What would you do? Just give us a generalized overview of where you would do it and how you'd spend that money.
Yeah, well, first of all, I've not ever been in that position, but a few comments. First of all, jurisdiction. I certainly favor the U.S. being an American, but there's a lot of problems. I mean, it took these little ISR projects 5-6 years to get permits in Wyoming. So I'd probably default a bit to the U.S. But one thing, and John can, I think, confirm it. Namibia. I mean, I was. I guess pleasantly surprised, let's put it that way, on the support from the government. And I think the environment there to work, particularly for a mining project, I think it was just excellent. Australia, I think, is still a bit tough. I think, and John can correct me, but from afar, I still see kind of an underlying anti-uranium nuclear, sentiment there. So I think it's a bit difficult. I'm not a big fan of going in and trying to fix old mines. And in fact, it's interesting, Cameco under Jerry Grandy, when they'd go into like Kazakhstan, he wanted to build, a Western style facility. So he wouldn't go in and try to fix something that, had lots of legacy issues, I guess. I think you have to have a sprinkling of that blue sky, of I've come to appreciate the geologic area, and some of them to me are almost, I don't want to call them magicians, but they're able to find things, do things that just continue to amaze me. And I'll give a little shout out to Ed Becker, John. I've always been impressed with Ed. So, probably a mix of things that, but not, I think you need to be able to come to market fairly soon. So that to me focuses maybe more on the ISR projects. If you can find some that are decent, like in Wyoming or wherever. But I guess that would be kind of my view. So.
Okay. John.
I would pick Namibia hands down.
Yep.
The reason is we came into Namibia in 2003 or through Paladin, defined the ore body, and in 2005 we were building and went through all of the processes. But it's you can get operations going quickly, and then the Husab, the Chinese, there's another $3 billion spent, and there's another mining operation there. So I would definitely choose Namibia. I think Australia is fraught with problems, and that you can build that into your strategy and how you exploit that. Canada is got huge issues. I don't think any of those companies, apart from 2 or 3 big ones, will ever get an operation going in the Athabasca. It's Cameco, Orano. That's the people that are going to be developing there. And in other parts of Africa, or South America, I know what it's like to build a uranium mine in a non-uranium country, and that was the first one that was done by Paladin in 30, 40 years. Nobody's done it before, because every other, there's been uranium mines in the US. All the jurisdictions are there. They all understand, so you don't have to invent the wheel. Canada the same, Australia the same. Really, the early uranium miners in Europe, Kazakhstan. So all these people that are in countries that haven't got uranium in them, and we've got to teach the people, the governments, all of the things around. It's a double, triple hard job. So if I had my thing, I'd concentrate in there, because I know I can get quick reward, and I know consumers, utilities, are after Namibian product in terms of their sort of diversity, and you can get large scale deposits. Production capacities of greater than 2.5 million pounds per annum.
John, do you like Botswana?
Well, Botswana is a great country, better possibly than Namibia, and all it has is the issues of not having that uranium experience. But they've developed a lot of other mines, so their regulations, their mining act has to then adjust to radioactive material. So you've got time delays in that whole process. But I like Botswana. Absolutely do.
Okay. Moving on here, back to Dustin. Dustin, how do you feel? How disciplined will Kazakhstan be in a rising uranium price environment? How disciplined will they be with their potential supply?
Well, certainly remains to be seen. I think they're now gaining fairly noticeable discipline on the downside. And I think what's driving them is their desire to do their IPO, because they need to maintain a certain spot price, is what they transact all their uranium at. I've heard that's $35. Now, if the market goes to 40 plus, will they, turn the bow of the Titanic and start putting in more well fields? Probably. I think there's going to be a tier of production in that 40 to 50, and it might be MacArthur, it might be more Kazakhstan. Just remains to be seen. I think there was a really interesting presentation in Madrid by Uranium One, and their view was if prices don't improve, Kazakh production could drop by 40% by 2030, because they're not drilling. They're not, doing better definition of their resources. So, and as John said, there's a spectrum of production costs. Everybody thinks that, Kazakh production is below $20. Well, there are projects that haven't gone ahead, Zarechnoye and in that general area, because they're much higher cost. Keep in mind, when they move to the new areas of production, they're much deeper, less permeable, 10 times, I've been told, the amount of acid is required. So, I think they've gone after the low hanging fruit. And so the next batch could be $40, $50 costs. So, I think they're becoming much more sensitized to costs as compared to just produce as much as you can, which again was a presentation from the Kazatomprom in Madrid. And they said the mindset at the production centers has been almost Soviet. In other words, more and more and more without any view of what it means for the market. And I think they've finally got that in hand. So, remains to be seen. So,
okay. I'm rolling up a few questions into one here, more or less to consolidate and keep our time on track here. So Dustin, with you again, with Yellow Cake, with the uranium participation, with these other unnamed funds, with Kazatoprom's trading house stockpiling, with all these stockpiling efforts, where do you see where these organizations might consider starting to sell? And with that, would they be looking at spot, or would they mostly be looking to secure contracts?
well, let me comment upon UPC and Yellow Cake. I think because the business model is fairly similar. At this point, there's no intention to sell. So I think now there have been internal discussions of, is there a shortage situation? And so a buyer, whoever it is, a big producer or a utility, comes in and says, hey, I'll pay you a big premium. I want to buy part of your inventory. Would that be considered? Sure. I think some of these other guys, the groups out of New York, remains to be seen. They're probably more short term, but I don't think they'll buy big volumes. And, trading house Kazatom in Zug, I don't have a good feel yet for how much inventory they may be accumulating. I don't think it's big volumes, because if it was, they'd be buying from kind of the mothership. So, will some of it come back into the market? Could, but I don't think it's going to be, a flood. I mean, I've heard the logic that the Chinese, when the price gets, up enough, they'll start flooding the market to monetize their profits on inventory. I mean, that's just illogical. That's just fake news. So, it's going to be a factor, but I don't think it's going to ruin the market.
Right. And I don't think that there's enough, there's not a substantial amount held. I mean, with the maybe example of Kazatomprom, these other ones don't have substantial supply in my view, at least not yet. So with that, I want to touch on the 232 petition, because we would really be, some folks, a lot of people are talking about this 232 stuff. So I wanted to just touch on that, and I'm going to continue with Dustin, and then we can get to John's comments on the discussion here. People want to know what effects the 232 will have. Will the U.S. be, in light of the 232, will the U.S. be one of the better places to have investments? And secondly, what would the foreign suppliers, what impacts on the foreign suppliers would happen in your view if a 232 was actually honored by the Trump administration?
Okay, well, very quickly on the 232, I know quite a bit about it because of my relationship with Energy Fuels. The petition has been filed, but the investigation has not been initiated by Commerce, and they may not initiate. That's what people, I think, need to get a good feel for. Even if they do, Commerce can come out with its own set of recommendations to the White House, and then the White House can come out with its own set of final tariffs or whatever. So again, the benchmarks that were submitted were just that. In other words, the producers had to present to Commerce something. Now, the 25% requirement of utilities in the U.S. buying new U.S. production, newly produced, would result in about 10 to 12 million pounds coming out of the U.S. industry, which it hasn't done since the 1980s. So it would take actually several years. That's why I'm not sure they'll come up with the 25%. But anyway, I know Trade Tech has done a pretty comprehensive analysis of it. And the impact on the foreign producers is less than $2 a pound, is what they've come up with. There's numbers floating around that U.S. production at the margin would be $100. So it kind of almost illogical that you could have a $100 market in the U.S. and some significantly lower non-U.S. market. If it's taken up and moved forward, are assets in the U.S. going to be more valuable? Yes. Will contracts be at marginally higher prices? Yes, theoretically. But again, I think even if it was at 12 million pounds, that's a couple of, it's less than one MacArthur River. So, it could create a two-tiered market, which has happened before, but it's not going to be, Armageddon for, I think, the non-U.S. producers.
Right. And before John steps in, I just want to say with that, the United States, there's nothing there. You would have to spend a lot of capital and spend a lot of red tape with the central planners and all the folks that are in the offices shining chairs. It would take a long time to ever have substantial production out of the United States. John, what do you have?
I think it will be a disaster. I think the U.S. uranium has had its day. I believe there's no sustainability in the ore bodies are low rank, used by those people who when they were producing 20,000 tons a year. They're producing now 220,000 pounds a quarter, and they have to go to 3 million pounds a quarter to meet that ambit claim that they think they can do. It is. They just haven't got the ability to produce. They haven't got the ore bodies that can say, "Oh well, we've got 20 years out there," and that's where I think that I think it's done the job. I think it's frozen the market out. I think it creates a problem of non-delivery and I believe it will be more than $2 if it's a privileged market like it was back in the old days, and it will be completely different because of the scarcity of product to come out of the US. Okay. That's my simple opinion about the 232. It was just two people put in this claim, virtually throwing a rock in the pool and seeing what will happen, and if it happens, well and good, but it'll be a huge problem going forward for the US producers, and they need a big price incentive to get to incentivize them into production.
Well, throwing a rock into a toxic pool at that. So I want to move on and kind of get wrapped up here. So the two exit strategy here that we have. So I tie this in because I know that, for you guys, this cycle here will probably be your last cycle that you guys will want to participate in. So there's an exit strategy for both of you gentlemen to move on and enjoy other things in life. And so before we get to that, I think this is important. Exit strategy is always critical, whether you're in the market or if you're just navigating through life. So in the case of uranium, what are the triggers that would tell you, a retail investor, that we are getting towards the end of the cycle? Dustin.
Oh, I think if we start to see the price certainly flatten out or start to weaken, some of the reactor programs that are currently very aggressive, and obviously the Chinese, the Middle East, the Indians, if those start to get, let's say reduced substantially, it'd be those kind of typical oversupply. Like John said, we could have a bunch of, guys decide they're going to create new mines that just don't cut it, but they bring product to the market. We're clearly not there. we're early, I think, in the cycle, and so but those are the kinds of things and there's always a black swan. We're asked that with yellow cake. Well, what if there's another Fukushima? Well, then you got big trouble. So, but just general signs, I think, would be weakening demand forecasts and more aggressive supply. Pretty simple.
John?
I believe with the filters to production, any shortage will be very difficult to fill, and it'll exacerbate the sort of the amount of supply that came in. So you've got a much more sort of hope of an extended high price, whatever that high price is, of uranium. Where I really have a quiet smile is when I look at how people act on fear, and fear is when you've got a family starving and there's only two loaves of bread left in the bakery, and it ain't going to sell for $2 a loaf, I'll tell you, and it won't sell even for 20 times that. It'll sell for a huge amount, and so price, if it goes from $20 to $50, there is a concern out there, and that concern of the buyer is not going to limit his fear to $50 a pound, because other people will come on top of him thinking that they're invading into their space out in the future where their term contracts are needed to be filled. So they'll start competing when utilities, even when the inventories are beyond that particular period, just to protect their position. So there is going to be, I think, a much more extended period. I think that any board that looks at future production is not going to, if it's got any sense, when does price sort of become real? When it sort of hits a particular point and then in 2 months comes down again? In that volatility, how do you get a high price for your uranium? On lithium, people are making 50 to 80% rate of return, and in this volatile market, which board is going to sensibly say, "Oh no, I'll develop this high risk mine," and some of these companies with market caps of 20 million are looking for 1 billion of loans or funding. Who's going to say, "Oh, yeah, we'll do it, and then we'll take a risk and just become, sort of servants, slaves to the utilities"? So all these setbacks in the end will cause this supply side to be really recognised as a slow release issue. Yes, Cameco can come in and expand to obvious areas in Canada. That's a good space. I think Kazatomprom has had its good day. It went from 3,000 tonnes in 2002-3 to 50,000 tonnes. I'm talking roughly, and that rate of growth is over history. They've got to contain that. They've got to hold that sustainably, and they haven't yet. They've got a plateau, and there's a serious issue now of those well fields not participating in growth, but to sustaining the current production. They have those problems happening. So yeah, look, I think there's a long thrust to this next thing. Apart from, I agree with Dustin. I think demand is there, but you never know. Countries could change their mind with renewables or whatever that goes on. But I think we're in a good space in that regard too.
Sure. And I just want to make a few comments there on that. So in our nuclear energy report that SmithWeekly Research put out, we talk about trigger points for retail and folks that are interested, the trigger points to sell. So we cover those in addition to what John and Dustin just said. We cover those in our report. So I would encourage listeners to look at our report because there's a lot of key trigger points for selling that's very important in our view. And then with that as well, when it comes to broad market crashes and black swans like Fukushima, we have written additional issues on those matters, which everybody has asked about. So we have written those. So I'd encourage readers to look into our material there. And then back to John's comments about loaves of bread. I think price discovery will be very interesting going forward. Price discovery is very important. It's just like whether you're in Venezuela, having dollars in your hands, US dollars is very important. It's a price discovery situation. Here where I'm at in Nicaragua, there's been an enormous amount of price discovery with relation to ammunition and firearms just recently. So if any of this stuff is a point, the price of uranium and the discovery price is going to be very much higher. So John, thanks for the loaves of bread comment. I like that. So moving on, after the cycle, what are you guys going to do when this is over? What are you guys going to do? You guys going to retire and enjoy life, take vacations? What's your guys' plan? Let's go back to Dustin. What are you going to do, Dustin, after this cycle?
Well, John will probably get a chuckle out of this, but I'll give you the 3 to 5 year time horizon. And the reason being, I told John that probably over the last decade at Paladin. Actually, what's kind of keeping me around is that as you say, reaching the summit. I think in that time frame, certainly I'm more toward the 2 to 3 years. We're going to see an upset in the market, and it's going to be persistent for quite a while. And so, I think this is kind of the fun time. We've gone through the long march. I think we're getting toward the end of it. And, I always try to stay engaged, probably, but, just kind of cut back. We already, as John knows, I've always enjoyed vacation times and things like that. So, but yeah, I think, probably get out of the way, assuming there's younger people that come in. I always believe there's a time when you're past your use by date to some degree, but it's off in the distance for a while now.
John?
Well, my sort of plan for what I want to achieve for Deep Yellow and where I think it can go, and to straddle that opportunity window for my shareholders. I think no matter when you talk about whether things are going to happen in the next 2 years or 1 year or 3, if you've got your foot planted on one side of 3 years and the other side of 5, you've absolutely got that period where fabulous things will happen. So I want to stay involved for strategic reasons in that, and I can play various roles, but the 3 years of that is going to be to put Deep Yellow into a space that nobody occupies at the moment, and that keeps me very young, keeps me thinking about opportunities that you need to give optionality to your customers out to 2040, and where are those pipeline of deposits going to align up so that you offer early production and sequencing to demand, not to some sort of regimen, because you're really locked into some pre-programmed outcome. So yeah, that's my look, and I come from a farming background, and all the successful farmers I've seen, they go a bit slower. They give it over to the young people, the younger family or whoever it is, but they're always there, and they wake up in the morning for a reason relating to what they've built up all their lives, and to have that veranda in life where you can do those things and enjoy your life. And occasional, I'm not a holiday man. I have my holidays down on my farm, but for those, whatever they enjoy, to give them time to do, and that's where I'm fitting in. I'm basically a workaholic, I guess.
Well, there's a drive to create value, and it's not just to collect a paycheck.
No.
There's the real drive to wake up and go to work and deliver value and there's a real passion, and I have that sense for this business right now, for this cycle, and I know you guys have an extreme passion to keep you guys in the sector for so many years. So it's quite it's quite an achievement. It's really impressive what you guys have been able to do over your careers. So it's really great, and there's more story to be told and more chapters to come. So, well, I want to leave it there, gentlemen. I want to know, Dustin, real quick, where are you going next in the world, to where if there's someone that might hook up with you at a conference somewhere, where are you going next? And then I'm going to have the same question for John.
Well, after my 2 weeks in London, I actually will be in Detroit, Michigan for the National Girls Volleyball Championships for the 14-year-old granddaughter. The next conference, really, there's one in Washington in July, a one-day conference with the NEI. The big conference will be September in London with World Nuclear, or excuse me, the WNA. And then in October, there's I think around the 20th, there's a big conference in Boston. So those will be kind of the cities over the next few months.
Okay, John?
Yes, I'm planning to be in Vancouver in mid-late July on the Sprott conference there, which is a great conference to be. It's got about 80 companies selected by the Sprott group. I'm going to New York after that, and a big exciting thing that's happening with us is we're going to list on the OTC QB platform, which will give the US real-time direct trading opportunity in deep yellow. So we'll be visiting and pushing and promoting that side much more. And then in September, I'll be in London on the WNA conference, and traveling a lot more in the next 12 months, both because of just getting deep yellow on notice now that I've got something to talk about, and also investigating some opportunities for expanding the platform.
Okay. So with that, you guys safe travels, of course, to all those conferences. And I would encourage folks who are listening and to this video and conference here to, these guys are some of the most highest quality people in this business, very top shelf. So I would encourage you, if you're at these conferences, see if you can hook up with these gentlemen and have a conversation. So with that, I want to thank everybody for taking the time. We hope you had some fun and gained some great knowledge from Dustin and John here, not only on the nuclear industry, but also in life, with the wisdom that they can share with us. So we're fortunate to have them here, and we appreciate their time. If you aren't a SmithWeekly reader and haven't joined us for the first time in this presentation, make sure that you at least check us out on our website, SmithWeekly.com. Or, of course, on Twitter. Our handle on Twitter is @SmithWeekly. On behalf of our guests in SmithWeekly, enjoy the journey ahead and take care. Thank you.